Welcome to Financial Repression Authority's Roundtable Insight, where the best fund managers, economists, and industry leaders discuss the key investment issues and challenges in the current macroeconomic environment.
Hi, welcome to FRA's Roundtable Insight. This is host Richard Benuli. Today is February 29th, and we have David Rosenberg, Peter Boockvar, and Ira Harris. David founded his own firm, Rosenberg Research, after being the chief economist and strategist at Gluskin Sheff. The firm offers extensive research and information services with a trial service that we'll post up a link to. He also served as chief economist for Merrill Lynch. Peter is chief investment officer for the Bleakley Financial Group and Advisory. He has a new Substack platform. It offers great macroeconomic insight and perspective with lots of updates on economic indicators. And Ira's independent trader, hedge fund manager, global macro consultant, trading foreign currencies, equities, bonds, and commodities for over 40 years. He was also CME director from 1997 to 2003 and a stint also more recently. Welcome, gentlemen.
Thank you.
Morning. Nice to be back.
Great. I thought we'd begin, David, with your global macro view on the economy and the financial markets.
Okay. Well, I think that what we've been seeing is a wide divide open up between what's happening with the global economy and what's happening with financial markets. I mean, here we have, for example, I know we'll talk a lot about the US, obviously, but here we have Germany in a technical recession, and the DAX hits a record high. When has that happened before? You've got the same thing. I've been on Peter as well. We've been very bullish on Japan for structural reasons, but Japan's in a technical recession, and the Nikkei just managed to break out to an all-time high. You could say the same thing about the UK and many other parts of the world. It's really a decoupling going on. You've got either recessions or economies on the verge of recession. And I don't know what you would call a recession in China, but they're certainly going through a debt deflation. And the stock market picks up there only because the Chinese authorities, moved to ban short selling at the open and at the close. And of course, the state agencies have been coming in as buyers. And we can argue about China being a very cheap market. I know that Peter, and I don't disagree with him, is very bullish on emerging Asia. They trade at cheap multiples. But as far as China is concerned, there might be a valid reason why it trades at a single digit multiple. So the global economy is, many parts of it are either stagnating or heading into recession. Doesn't seem to matter. And as far as the U.S. is concerned, everybody seems to have thrown in the towel on the recession call. I think that it certainly has been delayed, but I still believe in the business cycle. I believe in that when you go from 0 to 5% interest rates in a short period of time, it is a shock, and that shock was, shall we say, received an antidote from all the fiscal stimulus and other things that have been going on. But whether or not we're talking about AI, for example, we had the internet boom, and the Fed tightened policy aggressively after the Asian crisis and long-term capital fiasco was over, and we had the internet boom, but it didn't stop the economy from going into recession in 2001. And that's because there was nothing more powerful than interest rates, as Albert Einstein, who was a nuclear physicist but may as well have been an economist, famously said that the power of compound interest is the eighth wonder of the world. And people have forgotten about the power of interest rates, but also that they influence the economy with very long lags. And I remember being back at Mother Merrill in '07 under the same pressure today to change my call to the soft landing or no landing. And I'm so happy that I didn't, although, believe me, the pressure was there. And the lags were long. Back then, the lags were lengthened for a variety of reasons related to the last vestiges of the housing bubble influencing household cash flows. And this time around, there's been other factors at play, like the last leg of the excess savings file. I'm not going to apologize for the fact that I still retain a call it a bearish view towards the U.S. economy. I don't think it is an oasis of prosperity, although it has things going for it that other countries don't. And so I think that the recession that we didn't see happen last year, and I think maybe the lags just didn't have long enough to play through. But I think it's going to show through more forcefully this year. And in fact, a lot of the January data are starting to come my way on that score. As far as the markets are concerned, I don't know if I want to go out and say that we're in some sort of massive price bubble, but I would just say that, what is a 22 multiple on the S&P 500 telling you? It's telling you that the stock market is yielding you 4.5%. We can practically get that right now in the 10-year note, and you can get 5.4% on the 3-month Treasury bill yield. So I would just say that one of the big concerns I have is less about fundamentals, although I am in the recession camp, but it's more about the valuations. And when you have an equity risk premium that is either slightly positive, zero, or even negative, that's a concern for me because what it's telling me is that investors who are blindly investing in ETFs or in the indices, they are paying to take on risk instead of getting paid to take on risk. So, there's lots for us to talk about. I think that the stock market writ large, practically every sector, only two sectors are trading below their long-term multiples, and that's energy and it's the REITs. So when I hear people talking about how, well, the stock market, it's a different beast today, it's a digital economy, it's a digital market, it's not an industrial market, well, that's fine. And of course, we have 30% of the S&P concentrated in technology. But the point I'm making is that even with the ever-changing structure of the stock market and the concentration in these high-flying growth companies, the reality is that 9 of the 11 sectors of the S&P are trading well ahead of what their historical multiples are. And you can't say, well, interest rates are low, so that's justified because of where the cost of capital is or where the discount rate is. So I've got my concerns. I think that sentiment is off the charts. Peter's done great work on that. But I find that valuations are not a timing tool, but valuations should be respected because at any moment in time, the valuations tell you what your expected potential return is going to be over time. When the multiple is low, it's a long runway. When the multiple is high, and especially where it is right now, 22 times earnings, wow. That's an ongoingly a source of concern for me.
Great. Those are interesting observations, David. And what are your thoughts, Peter? And you mentioned, David, on the your views on the emerging markets in Asia. If you could elaborate also on that, that'd be great.
What David said in one of his writings over the last couple of days, I've been echoing myself, is that I haven't seen ever this many cross currents flowing through the global economy and the U.S. economy. You have consumer spending, you have the high end consumer that's going to concerts, but they're not spending on electronics. They're traveling, but not buying furniture. The low-end consumer is, Wall Street Journal talked about it. They're eating more rice and beans rather than eating out. We heard from Dine Brands that owns IHOP and Applebee's talking about how just consumers are going out less, or at least lower income consumers. Everyone looking for value. What does that say about the economy when you're searching for value? More so than you have in the past. You have the pace of existing home sales near 30-year lows, but the pace of new builds doing better. You have manufacturing globally that's in a recession, but hopes that maybe we're close to bottoming out, but that remains to be seen. You have government spending that's just layering on an enormous amount of government, or I should say, economic activity, but you wonder what the paybacks are going to be. Just as we're incentivizing people to build EV battery plants, there's been a collapse in demand for EVs. So how many of those factories are going to get mothballed? Global trade, very, very modest. As David pointed out, some of the recessions and slowdowns in growth that we're seeing overseas. So there's just this really bizarre confluence of economic activity that makes things really difficult to figure out. And one last thing, You look, everyone's talking about this AI hype, which for NVIDIA and others is real, but capital spending, generally speaking, is basically flat. And we've heard whether it's um, what's the Palo Alto, Salesforce, Snowflake, all talking about a slowdown in the spend on their software products. But maybe that's because businesses are reallocating capital spending to AI related initiatives. But on a net basis, capital spending was essentially flat in the last 2 quarters of last year. And based on what we saw with core durable goods, showing no signs of rebound in January. I still think that we have another couple of years for this higher cost of capital world to flow through the economy. We have about 750 to $800 billion of corporate debt that needs to get refinanced this year and another trillion next year. Now, a lot of that's getting done. We had a very active February, but it's getting done at higher interest rates than on the debt that's coming due. And one thing that, we analyze the current data, but we also have to wonder is what economic activity is not taking place because of higher interest rates? What building is not being built because of higher interest rates? What business is not getting started because it's tougher to raise equity and debt capital in this kind of environment? So I still see sort of a death by 1,000 cuts that doesn't show up like it did in 08, which David was clearly on top of then. I think it sort of just chips away. But, then there are also, like I said, pockets of strength with travel and leisure. And if you are a baby boomer that's finally getting a 5% risk-free return on their savings, and they're going out on cruises and they're traveling and they're finally reaping some benefits from their savings after 15 years in the desert looking for interest rate water when rates were at zero. So it's just really confusing. And to add on to what David said about the markets is in this kind of environment, with this higher rate environment, and now historically speaking, you can say, okay, rates are where they should be. But the problem is that rates now come after 15 years of zero. So that's where the shock takes place. And do you want to pay 22 times earnings for this? I'm not going to poo-poo NVIDIA because we're longer for some clients, but and the numbers are just off the charts. But when you see a $260 billion market cap increase on a $2 billion revenue raise, that's 130 times sales multiple that you put on that. That tells you that we're in this frenzy that can last, but when rates are this high, it does matter. I do think a part of this as the year progresses is the Fed's balance sheet is going to be a big deal because there was a time when everyone got excited about QE. There was a time when QE ended and markets fell, and we saw what happened with QT and rate hikes in 2018. Now all of a sudden no one cares about QT because they think that it's being offset by this decline in the reverse repo facility. But QT, I think, as the year progresses, is going to matter. I think Jay Powell wants a much smaller balance sheet, and that sort of form of tightening is going to sort of establish itself in risk assets. And one last thing, and I know David's talked about this too, as I have, is it's extraordinary how tight credit spreads are. It's unbelievable how much risk people are willing to take on the credit side, believing that some Fed rate cuts are somehow going to save us. That the Fed taking the Fed funds rate to 5.5 to even maybe 4.5 is somehow going to cure all our ills, I think is hugely misplaced. And the amount of money that's piling into private credit, I think I get 10 emails a day from some pitch on private credit that I just don't see how a lot of underwriting is going to end well here. And that the belief that somehow the Fed is going to save us on some rate cuts, I think is misplaced because a 4.5% Fed funds rate is far different than zero. And the economic foundation of the global economy for 15 years sat on zero. And this adjustment process is still going to take years to come. And now over time, this will be a good thing that we have more normalized interest rates, no doubt. But the withdrawal period from zero is not over yet. And lastly, to talk about emerging Asia, when I think about where is economic growth going to take place over the next 5, 10, 15 years, Europe is not growing at best. U.S. growth potential is two-ish, and you can say that for other developed economies. But to me, the very exciting global growth story is the growing middle class in Asia. And China's challenged, but the size of the Chinese middle class is going to double over the next five-ish years. Indonesia is seeing a sharp rise in their middle class. India, which David and I have been bullish on, also is an extraordinary story. They just printed an 8.4% GDP number for Q4. Thailand, Vietnam, these are all growing middle classes that are going to be the engine for growth. And it just so happens that half the world's population lives on that side of the world.
If I can just add one thing to what
great
Peter
points
said
off.
about India,
Sure.
8.4% growth and inflation's coming down. And I was doing a deep dive. I mean, they're seeing significant, almost like Reagan-esque type of supply side growth. I mean, Modi is a interesting person and obviously a huge nationalist and could be argued to be a divider, not a uniter. But what he's been able to push through in terms of infrastructure improvements, which was always the big knock. The big knock on India relative to China was the fact that infrastructure was lacking, communication, power, transportation. That's all improved dramatically. Their productivity growth, and this has nothing to do with AI. This is actually just straight old-fashioned infrastructure has been really impressive, and their productivity numbers have been rising markedly. So I think that's why people say that India is expensive. However, I think that they're just much like Japan for different reasons. They're going through a secular positive re-rating of their assets.
Just to add to something that David just said, I work with someone who is Indian, whose family's there, and just to sort of explain like the extent at which this infrastructure build is taking place is that they're reducing travel routes from point A to point B that would normally take 7 hours down to 2 hours with all this highway construction. So it really is extraordinary, the leaps and bounds that's taking place there on the infrastructure side.
Yeah, the infrastructure build very aligned with we did a recent podcast with Louis Vincent, gave his views that he mentions if you draw a line from Turkey to Indonesia, including India, as well as other countries, Kazakhstan, Uzbekistan, massive growth. Look for growth in that area instead of China at this point. That's what he had mentioned in our podcast with him. Yeah. Your thoughts, Ira, on all of this?
Well, okay. And I know if we go, I think we did our first podcast together, the three of us, 2 years ago or 3 years ago. Yeah, no, it was probably the second.
I think it was early 2020.
Yeah, it's probably right. And I will say this. Yeah, and David talks about, seeing the business cycle out and and it's been a difficult period because the amount of course, fiscal stimulus in a non-war. That doesn't mean there's not wars going on, but the last time, of course, we have to go back to the 40s to see this type of robust spending. Maybe the 60s with the guns and butters approach of the Johnson administration, but it's been very hard and it's been very difficult on the debt markets, as both Peter and David point out, because number one, you've had massive central bank intervention. We go back 2 years, just 2 years, and you had 18 trillion of sovereign debt with negative nominal yields. We've never seen anything like this. And then you throw in, of course, the massive fiscal stimulus. This has been very difficult. And of course, what has it led to is equity markets being the recipient of it. But now I think we all agree on the payouts to people who own 1 year T-bills, 6 month T-bills, is putting money in people like, I'm of that age bracket. And as I would, when I was blogging regularly, and I would explain to people that you could see this. I had a $1 million T-bill in my trading account that in 2020, 2021 was earning $3,000. That was 30 basis points. And then all of a sudden it's earning 55,000. That's a significant stimulus to people who are savers at the upper end. And as Peter and David both pointed out, that was the group that for 15 years was the recipient of massive financial repression. That was how it was built. Borrowers were benefited and creditors were harmed. And now the markets it's taken them a long time to adjust to this process. But this group especially, we don't bend to anybody because we got very bullish Japan very early, even before Buffett. And we can go back to those podcasts and listen to them. So I don't apologize for anything. And we're all going to be wrong at times. But we're also learning, as Doomer put out a piece the other day doing his mea culpas on things that he may have gotten wrong. And that's absolutely right. Global macro, there's so many moving parts. It is a phenomenally difficult. I mean, we're in the middle right now, where as long as we're talking about Asia, Japan has gotten away, I believe, with they've been benefited greatly because as long as with the US raising rates and Europe raising rates, the carry trade has been back in vogue. Now, and that has meant that as Japan has held rates negative or at zero and long rates low, we're back to doing the famous carry trade where you borrow in yen and invest wherever else you can in the world, and you generate returns that way. So that's a great risk-on profile. But I would be very careful here because I think people are going to wake up to that the yen has been so artificially weak. And yeah, I don't want to hear about the 250% in deficits, because a lot of that is Japan owing it to themselves, unlike the United States, which I believe 40, maybe 50% of the debt is held by people outside the United States, which makes it a far more different dynamic. But the yen has been so weak on all the crosses, which gives credence. Even, as I did a podcast a couple of weeks ago with Larry McDonald, and I was really kind of surprised that he brought up the yen yuan, which Peter and I have discussed about. I don't know whether David and I have, but it's been a critical element. And it's at levels, it's one of my most important crosses to me because Bill Clinton taught me that it was important. So we're back at the highs that we've been at. And that's a very interesting chart that the yen has been so weak against the yuan. But I think that's been part of a policy of the United States as everybody was trying to move stuff out of China and reshoring things, that they were giving a benefit to the Japanese and allowed the Japanese to carry a weaker yen, especially now that the carry trade is back in vogue. But today's February 29th, the last day of the month. And the yen's not the only one. I look at the interest rate differential. One of the other crosses that I love to watch is the Swiss yen chart. And the Swiss Japanese interest rate differential on the 10-year note is about 10 or 11 basis points. That's not a whole lot of carry in that trade. So you may as well use some Swiss currency if you were looking to do some carry trade. I wouldn't advise it, by the way, because the SNB does so much in the markets. It makes it a difficult trade. But there are other things going on in the world. And as Peter talks about, and David, looking basically to Asia is going to benefit a lot here. And one other thing, and I know we talked about this, David, back when the United States was pushing, especially as things were heating up with Taiwan that was a little while ago, probably 18 months ago, 20 months ago. And they were pushing everybody in Asia to spend more on defense. And we talked about that. I said, that's going to come and bite them in the face, because the Japanese ramping up defense spending, they're not coming to the United States to buy their defense goods. The Japanese are very capable of manufacturing defense-oriented goods quickly, and this will aid and abet them. And I think that's actually helping Germany at this time, because defense spending is no question is going to increase in Europe, and that's going to benefit the Germans. The Germans still have they may not have much of a defense army per se, but they're very active in defense industries. In fact, as Scholz has reiterated several times in the last 3 or 4 months, Germany is supplying the Israeli army with a lot of military goods, artillery, ammunition. And he said, we will not stop doing that regardless. We feel that that's a moral responsibility that we have. So the German defense industries are going to benefit massively from the fiscal stimulus that's going to take place in Europe. But Germany will benefit. And I think that's why the DAX is moving up on the come.
Any thoughts, David, on geopolitical risks and trends affecting the economy and the financial markets?
Well, I've always said that it never really pays to invest around geopolitical events. You want to invest around the economy, policy, interest rates. But geopolitical events, I mean, that's not why I've had a cautious view on, say, the U.S. stock market. Had nothing to do with the fact that we got a war in Europe and we have a war in the Middle East. I never found that investing around geopolitical events was a very good idea. The only point I want to come back to is something that Peter Boockvar mentioned at the beginning, which is all these cross currents that are taking place in the data. Because if I told people that real gross domestic income, I mean, there's different parts of the national accounts, but because we love spending, we focus on GDP. So GDP is up 3%, but GDI is flat on a year-over-year basis. We've never seen a divide that big between spending and income. And of course, filling that gap is leverage. Well, what sort of multiple do you want to put on that? Peter mentioned the discrepancies incredible between the existing housing market, which is dormant and sclerotic, and the new housing market. There's just, cross currents everywhere. Even within the employment data, the household survey is flat year over year, and all the job gains have been in part-time. As we take full-time workers, make them part-time, not all jobs are created equal. The non-farm survey, because everybody, including the Fed, worships non-farm payrolls and GDP. GDI and GDP, a huge divide, and the household survey and the payroll survey, huge divide. What do you believe? And then within the payroll survey, which is so bullish, 353,000 jobs in January, if you believe the number, and we'll get another one next week. But what about the work week? The decline in the work week in January wiped out that employment gain, but nobody talks about that. That the index of aggregate hours worked, which is the labor input to the economy, is actually contracting. So, because companies don't want to lay people off, so we'll cut their hours, we'll push them to part-time work. And so you've had that other dichotomy, like in the jobless claims numbers. And again, Peter's been talking about this, I've been talking about this, that another wide divide is that you have these low levels of initial jobless claims, which is telling you that firing rates are low, but then the backlog of existing claims continues to ratchet higher. And it's telling you that people are having a difficult time finding a job. So there's all these divergences and cross currents that can make your head spin. And the question will be what converges on what. But I think that right now the consensus is leading towards the indicators that are showing the economy with a certain verve and panache, and ignoring a lot of the other ones. And let me just tell you this much. This is more on a personal note. I'm noticing in my client base, I got 3,000 clients in 60 countries, and we're noticing a trend that a lot of them, a growing number, have stopped opening up the material. They've stopped reading. And when I try and canvass, why are you not opening up the research that you're paying for? They tell me, we don't want to read a bearish story. So we've tuned you out for the time being. And it just reminds me, you know, when I was at Merrill in Canada in 2000, and word got out because I was on the investment committee, and I voted in the beginning of 2000 to take Nortel out of the top 10 Canadian stock list. Word got out that I had done that. We never took it out. I'm the only one, along with Robert Spector, who was my number 2 guy there. We got voted down, but word got out, and I got punished hard in the Canadian II vote that year. And then look what happened. And then in 2007, when everybody was throwing in the towel for the recession call, the only other person calling for recession in 2007 was Dick Berner at Morgan Stanley. And all of a sudden, I noticed the sales force stopped taking me around to see clients. And I said, why has my marketing schedule been so depleted? And they said, nobody wants to hear your bearish story. And then guess what? In 2008, there were weekends I couldn't come back to Toronto because I was inundated with requests to come see these clients once the damage was already done. So you can use that as a bit of a contrary indicator. You know, I'm doing my best to look like Peter Boockvar and like Ira. I'm trying to exercise. I go to MadCan. I go to the gym 2 to 3 times a week. I'm doing my best. My trainer told me, and MedCan is high end, and he said that their sales are going down, and he said his clients, who are business people, are telling him that their sales are going down. So I'm talking to my trainer, and he says to me, I wouldn't walk away from your recession call, because he says, from the people, what I'm seeing here at MedCan and what I'm seeing from my clients, this recession that everybody thinks isn't going to happen. This is from my trainer. He says, this recession you've been calling for, Dave, is probably starting right now.
Interesting observations on your clients.
On a more personal note.
Yeah. Are you hearing the same thing, Peter, from your clients, or the general mood?
Well, when you think about it, when you slice and dice GDP, I mean, some parts of the economy are already in a recession. Manufacturing's been in a recession for more than a year. The existing home sale market's in a recession. And when there is not a home that's being transacted, there's less paint being bought and carpet being bought and new furniture being bought. And you listen to Home Depot and Lowe's talking about the slowdown in the do-it-yourself business. You hear about Walmart for 3 quarters now talking about the choiceful consumer. You know, more to what Dave was saying on the labor market, I listened to what a lot of the online job posting companies say. ZipRecruiter for 3 or 4 quarters now has been talking about the slowdown in the pace of hiring and less need for their services. I mean, you're a small, medium-sized company in this country right now. You're dealing with a 9% on average cost of capital. So look, I would say really between 8 and 12. And if you run into trouble, well, there'll be some generous Wall Street private credit person who will lend you money at 13 or 14%. Those are really difficult financing conditions to not only keep your business if you're not generating free cash flow, but to expand your business. And so I think that there are plenty of pockets of the economy that are already in a recession. And David's mentioned earlier about Germany and Japan and the rest of the world that is searching for growth outside of the unique stories like India or Indonesia, for example, or even Mexico, that's been a beneficiary of this transition of manufacturing facilities away from China into other parts. So they're already, the low-end consumer, they're in their own personal recession as well. Not only in how they're allocating their spend, but the savings rate being about 200 basis points below a 20-year average. And if you're not paying off your monthly credit card bill, you're paying 22% interest rates on that. That's a difficult environment to make it through. And one last thing on the labor market, and David's talked about this for a while, is that over the past year, all the job growth is part-time. You know, what does that say about the attitude of employers about adding to their job base if they're not willing to take on full-time workers and they're more interested in finding part-time people? You know, that says a lot too.
Yeah, exactly. And your thoughts, Ira, on what Peter
Yeah,
and David
let
are
me just,
mentioning? Yeah.
I want to speak to David's because I'm not saying that you invest in these countries because of the political events now. It's like, people who talk about buying gold when war breaks out. That's the biggest foolish trade that I've learned over 47 years of doing this. If you buy, if you buy certain assets because the headline news, that's a terrible way to invest. And I have the scars from the gold, especially all the precious metals that I trade. You better have a much longer term view as to what you think is wrong with the world. So I just want to speak to that. And I also, David brings up a very important point. He used the word leverage. And that leverage is what's highly involved in this market. I don't think any of us really know how much. But that raises that issue with me about a phrase that now makes its way into the lexicon, not for everybody, but R star. And what does R star mean? Well, I know what it means historically, and I know what real yields mean historically. But what they fail to take account, and I mean up and down that Fed group and all other places, I can get to the Bank of Canada, I can get to the ECB, I can get to Bank of Japan. When they talk about real yields, if you don't consider, in my mind, the amount of leverage in the system, and the system is highly leveraged because the system was forced to be highly leveraged because that was the basic of the Bernanke plan with portfolio balance channel going back to, I believe, Jackson Hole of 2010 when this was laid out. So the massive amount of leverage in the system, you can't go to higher quote unquote neutral rates. If anything, you have to err on the other side because a highly leveraged economy, as the US has showed you, certainly since I'm old enough to do this, and probably in the 60s and 70s, a more highly leveraged economy requires real yields to be either zero or negative. And I think that's where David's work will really show itself because he speaks to leverage. And I think that leverage issue is a very serious issue. And that's why, all of a sudden, Powell, who in December at that press conference had everybody stoked, and I use that word in its full meaning, stoked for 6 interest rate cuts. And we saw that all the way through, at least through the end of December, early January, that the market was predicated on that. Well, that has disappeared. But I wouldn't take my eye off that leverage ball. So I think that's an important, very important phenomenon going on. So I know David will probably speak to that. So I'll step back and wait for that.
Go ahead, David. Did you want? Yeah.
Well, I think that's 100%. I see so many people out there claiming that the neutral interest rate is going to rise over time, because of fiscal policy, which is ridiculous because this excess of debts is actually a future constraint on aggregate demand. And the higher debts actually is a drag on the real rate, and so is aging population. I'm spinning my head reading some of the stuff that's out there for my competitors. All that said, going back to the Fed, and maybe they're partly responsible for it. I started the business in the mid 80s. The Fed was always important. Monetary policy was always important. The forward guidance was always important, but I don't remember a day where an adjective or an adverb or a pronoun causes the markets to freak out. And now, of course, you have people using AI tools to figure at the margin, was the last speech more or less hawkish, or the last FOMC minutes. It's gotten to a point of ridiculousness. But the Fed partially orchestrated this through Bernanke by having people just speak way too much and way too often. And and just I think it was Mary Daly back in December. She's the one that opened that Pandora's box of maybe we'll start cutting rates in March. And next thing you know, the markets are what are they going to do? They're going to price it in. And then everybody lines up and says, no, 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 we're not going to do March. We're sticking with 3 cuts. There's no way. Look, I am bullish on treasuries. I like a lot of their characteristics. I don't care about the deficits because you'd find historically that in periods where the deficit goes up is usually periods where treasury yields go down. The correlation is ridiculously low. What's important is what's happening with inflation expectations, the contours of the business cycle, and the most important determinant of yields out the curve is expectations of Fed policy. That's why we had this monstrosity of a rally right out the curve. Nothing else happened. What else happened in December except the view that we're going to have 6 cuts starting in March and the 10-year note goes to 3.8? And then all of a sudden we go back to 4.2, 4.3, and it's only because nothing changed except for the revised expectation what the Fed was going to do. Nothing else changed in terms of fiscal policy or regulatory policy. And we could argue about the data weak, data strong. It's just all about the Fed. 90% correlation, 10-year note yield, and expectations what the Fed's going to do. But I sort of feel sorry for the Fed because it's sort of like, what are they going to do? How are you going to cut rates with a 22 multiple? Or basically you have double B spreads, some like 200 basis points below their long run norm. I mean, financial conditions are just too easy, and the Fed looks at financial conditions. So I think that there's not a snowball's chance in hell, unless we get some really, really ugly economic data, like negative payrolls, we start seeing negative GDP, that they got to see the stock market break. I'm saying that I'm pretty convinced that as they sit around the mahogany table, they're all saying, like, what the hell is going on here? AI or no AI? AI is not really new. It's okay. It's NVIDIA. We got a frenzy going on here. There's no doubt about it. I'm not going to say it's not real, but the Fed is there saying, how could we have done all this? I mean, financial condition index is about 300 basis points easier than it normally is when we make that transition from a tightening cycle to an easing cycle. There's so many things we haven't seen before, but they're saying to themselves, what the hell is the punch bowl still doing on the bar counter? How is the punch bowl still there? So, the thing is that if you think the Fed's going to cut interest rates, which I do, the S&P 500 is not going to be sitting above 5,000 the day that happens, and the multiple is not going to be 22, and credit spreads are not going to be 200 basis points below their long run average and 100 basis points below the average they are when the economy is booming, let alone being in some sort of soft landing. So I've sort of pulled back my views on what the Fed was going to do. I thought that they'd be cutting rates probably, I never said March, but I thought by May or June. It might not be till next year. And then at some point, the pressure is going to bear because these earnings yields in the stock market cannot compete. At some point, someone's going to wake up and say, why am I here at a 5%, 4.5% yield in the stock market when I can get 100 basis points better in treasury bills? At some point, someone's going to wake up and do the math. And so it's at that point. But I think really it's almost all about the stock market. Barring a string of horrible data, it's all about the stock market, I think, as far as the Fed is concerned.
And your thoughts, Peter, on treasuries as an investment asset class, also on Fed policy trends?
Well, I just want to add, I mean, to David, what David said is like we've basically rallied ourselves out of rate cuts. The market that so desired them has just taken their candy to such a great extent that we rallied ourselves out of it. And I think the Fed is getting the inflation trajectory that they've wanted. I think that they're focused on keeping it there and having inflation stay down, not just temporarily come down. And I think that is that's why they'll continue to be patient, because they don't want to obviously be in a position where things curl up again and they're stuck cutting interest rates while goods prices move up again. That's what I think they're waiting for. And I think Jay Powell is going to be less influenced by his dovish peers, and I think is going to be more focused on, hey, you know, the economy's hanging in and markets are at highs and credit spreads are tight. Why do I need to do anything? That's why I think a big focus should be to what happens with the balance sheet here, because that could affect markets. Moving the Fed funds rate, the Fed is used to influence the economy. It was the balance sheet that was really used to influence asset prices. And this time around, it's amazing that, again, QT hasn't really negatively affected asset prices because of some of the offsets, but I think QT kicks in. And where the market goes also depends on how hard of a recession you eventually get. I can promise you if the S&P 500 to 3,000, those upper end consumers are not going to be spending like they are today. I can probably assure you that a lot of those cruise line vacations in the back half of this year will be canceled if the S&P 500 goes to 3,000. So where the stock market goes will be a big influence. Now on treasuries, I think that long end rates are still going to remain elevated. It is hard. I agree with David. It is hard to sort of draw the line between deficits and rates because for 40 years, deficits went higher, debt went higher, and interest rates went lower. I think that the bear market in bonds started a few years ago, and that just maybe, and we'll have to see how this plays out, things might be more that these debts and deficits might be more influential on the margin to where long rates go. Now, I'm not saying that long rates spike, but maybe they remain elevated than they would be otherwise. Like I would not be surprised if the Fed started to cut short-term interest rates, that long-term interest rates didn't fall that much or even rose if the markets felt that the Fed was sort of giving up their inflation fight and longer rates would adjust for that. We'll have to see. I am very closely watching, even though at this point it's very well telegraphed that the BOJ is going to get out of negative interest rates. I mean, they're basically telling you it's going to happen and possibly removing yield curve control and see what kind of influence that has on both the Japanese yield curve and whether that filters into other yield curves, particularly in Europe and the US. There is a relatively higher correlation amongst the different bond markets over the past couple of years in this sort of post-QE world that we're in. So that's something that I'm focusing on as well. And that higher for longer in rates, whether it's Fed-driven or market-driven, is a real thing. And we still have time to adjust. Somebody's commercial real estate loan likely came due today. And they probably are having a really difficult time refinancing it if they didn't come to the table with more equity and they didn't have a bank that was that friendly in extending it out. So there's a lot of dislocations to be had in this very highly levered world at a much higher pace of interest rate, or I should say level of interest rates relative to the 15 years leading into 2022.
And your thoughts, Ira, on Fed policy?
This conversation is great. David, I have to ask, did I hear some Ricardian equivalence seep into your discussion?
Well, it didn't. Well, it probably should. However, look, the one thing that we know, and this is just based on the IMF, is that we're going from, I mean, 2/3 of the economic growth we had last year, directly and indirectly, came from fiscal stimulus. That's not recurring. And the IMF's numbers are such that, because look, the U.S. government, I mean, the fun and games are over. They're running fiscal policy on a set of continuing resolutions. I mean, come on, the net drag from fiscal this year is going to be -1%. People talk about the CHIPS Act here, CHIPS Act there. That's not the only thing going on. When you look at overall fiscal policy, it's going to be a -1 percentage point drag on GDP growth this year. But then we have to consider, when you're talking about interest rates, look, I said before that you're going to find there's times when the deficit balloons and bond yields go down. And that happens a lot in recessions because the automatic stabilizers kick in. But the reason why is because what does the private sector do in economic slowdowns or recessions is they delever, they deleverage. So you can't look at the market in a vacuum. The reason why treasuries rally in a recession with booming deficits is because private sector debt is going down. And I'm looking at the data. Look, we know. Look what's more important. I mean, we talk about the corporate sector, but nothing's bigger than the consumer sector, 70% of GDP. And you're seeing what's happening already. Delinquency rates going up for autos to credit cards, now starting to go up for residential mortgages, albeit from a lower level. And we got this data that I think you commented on, Peter, the National Association of Credit Managers, the NACM index. And look what's happening in terms of credit rejections, credit application rejections. They're going up a lot. And disputes, you're seeing the Federal and Officer Survey still remains that the lenders are tightening. What's filled in the void have been all these middle market lenders. You said the private credit. How long is that going to last for? And where are they going to get their funding for? Yeah. So I think that when people say to me, oh, government deficits, but what's happening in the private sector? And I think that you're going to be seeing a lot of unwinding in this excessive leverage of the private sector. That's going to act as an overwhelming antidote for the borrowing requirements we're seeing in the public sector. Last year, of course, bond yields went up and we had a booming deficit. But, you know, the reality is that you had a booming deficit, not in the context of a recession, but in economic expansion and sub 4% unemployment. Well, you're full employment and you get that sort of fiscal juice, you're going to get bond yields going up. That's what happened when Trump cut taxes back in 2018 at a time of full employment. The deficit ballooned and bond yields went up. So I'm not saying that bond yields cannot go up with rising fiscal deficits, and Peter actually nailed this last year, but I think that the economic environment is going to change. More often than not, by the way, bond yields do go down when deficits are on the rise, but it depends on what is the macroeconomic climate at the time, because that'll determine the other part of the equation, which is what is debt doing in the private sector. Just remember what the deficit did in 2008, okay? Ballooned. And you don't want to be short bonds in 2008. Why? Because we went through deleveraging. Now, that's an extreme example, but you get deleveraging in the private sector in every recession. And that's why interest rates come down, even with a rising deficit. And I want to hammer home that point.
So good. I'm glad, because even I need to be hitting the head with a sledgehammer when the private sector, because when that does deleverage, it has to go somewhere. Now, I happen to be in Peter's camp, though, because that's why I think that the curve is going to steepen from where it is now, because I think this curve has been so bastardized by all central bank, not just the Fed, but everybody. I mean, it's all one policy. I could read their statements, and you want to talk about plagiarism? Well, it's the central bank statements from the ECB to the BOJ to the bank. It looks like Claudine Gay was the researcher on them, because they all come off of the same artificial intelligence site. But I think that's really important, because I miss that too. Because I'm a big believer in looking at, as I know you are, over the years, that you look at government spending, but we forget the private side of that equation, especially in this economy where it has been so levered up. And we look at data today. So we see that, again, people are being denied credit, and people who are certainly more than credit worthy are stepping back from using it. So yes, I see that, but I still think that if that's the case, the Fed's going to have to get a little more aggressive on the front end. And that's really what puts me in that camp where I'm looking for a bull steepener, so to speak, especially on the 210 more than anything, because of that. Do I want to go out on my duration? Not yet. I'd have to see some other things develop in the world. But I'll tell you what, when I look at it globally, and this is where I think you can really hit it out of the ballpark with this, is if the Chinese, and I'm not buying into the China weak, there's so much that we don't know about China, and everybody keeps talking about the currencies, but if I go to Michael Pettis school, which I absolutely believe in, is that I think it's right theoretically, and I think it's right practically, is that in order for China to really enrich its middle class, it can't afford a currency depreciation. That's the old school. And I don't think that really works, because they need to build up their middle class. They have all this capacity, and if it's not going globally, if it's not being dumped globally, it has to be absorbed by their middle class. So weakening the yuan, uh, which is the old playbook, I don't think works very well. But if they were to panic, as some people think, and they were to intervene and weaken the yuan, especially against the yen, well, then I think you're going to get a global pressure on prices that will uh, speed up whatever we've just talked about. That will do a lot because global capacity is still vast and it'll put downward pressure on prices globally. So I think the yen is far more critical in this than a lot of people want to believe, because the Japanese, look at who are the two biggest car exporters in the world, China and Japan. And when I saw China's auto export numbers, they're huge. Now, Japan has had a resurgence because of the weak yen and because they didn't go to EV vehicles, they went hybrid, and they're killing it in the hybrid market. They are absolutely killing it. As people are stepping away from EVs, hybrid sales are booming. So there's a lot of things in play here that could really, as you say, especially in a highly leveraged economy, and the global economy is nothing but leverage. What's going to be that proverbial spark that starts that prairie fire? I don't know. But if it comes via China and the devaluation of its currency in order to enhance its economic prospects, well, then I think then we're going to get to that in a much faster, much more rapid pace in a total global deleveraging, which will wreak havoc on global bond markets.
And just a final question, your thoughts and ideas, David, on investment asset classes that may make sense in this environment, especially with the divergent trends.
Well, I'm still, I believe that we're still going into a recession. I haven't thrown in the towel. And in recessions, treasuries make you money, even though you could argue, even in the mid 70s and early 70s, bonds outperform stocks. So I still like long dated treasuries. In the equity market, I think that we're all in agreement that and actually our scorecard for our monthly strategizer document has been bullish on emerging Asia. We're still very bullish on India and Japan in particular. You could argue that Mexico looks very good and obviously a beneficiary of the friendshoring. And there's other reasons. And there's parts we didn't talk about, South America or Latin America, but I throw them into the bucket too. I think that I'm not bullish on China. I don't have the visibility there. It's obviously infected some of the satellites like Hong Kong, but there's other parts of Asia you can invest in, and there's other parts of emerging markets you can invest in too. And South America has some positives going for it. In terms of the U.S. equity market itself, I think that my sense is that it's going to be active market over passive. I think that the areas you can invest in my opinion, is the areas that you'd want to own if you have my recession view. Um, I'm not going to get into long-term growth or AI, and maybe these people that say that you're buying these stocks for the long run and for the a multi-year productivity cycle and valuations don't matter, or maybe earnings growth is being underestimated, for these well, I'm going to say Mag 7, but maybe it's Mag 3 or maybe it's Mag 1. I had a webcast of my own a few weeks ago. I had these two AI experts, and one of them said that there's going to be a Mag 7 5 and 10 years from now, but it won't be the Mag 7 that we have today. But I'd say I want to invest in things that have some visibility, which means that I want to be very defensive given my macro forecast, whether that's utilities, whether that's, which I view as a bond proxy. The REITs selectively would do well in a lower rate environment. I think you could argue that some of the financials, if the yield curve pivots and steepens, some of the banks, maybe not the regionals, but the big banks might probably do well under that scenario. Healthcare. So I just be concentrating mostly on, and if I'm long equities, how am I going to control for the cyclicality of my portfolio, and how am I going to limit the beta exposure? That's really what my focus would be on for the next, say, 6 to 12 months.
Interesting. Yeah. Yes, Peter.
So the way that we've been playing sort of emerging Asia and its rising middle class is we're along Macau casino stocks, Trip.com, which is the largest online travel agency in Asia that just reported good numbers. AIA Group, which is one of the largest life insurance and broad insurance companies in Asia. So growing middle class, you need life insurance among other financial help. Also exposure in Japan, in India, Singapore, Vietnam. The most recent trade idea that we've put on is agriculture, corn and soybeans in particular, not directly, but playing them through the fertilizer stocks. The fertilizer stocks peaked right after Russia invaded Ukraine, which we had been long going into that, not obviously expecting that, but gifted that from an investment standpoint, or otherwise, and sold into that and been waiting to get back in. And now you have the net speculative short positions in corn and soybeans at record highs. So the Mosaic, Nutrient, to name two, are very much beaten down, and paying with good dividend yields, cheap valuations is pretty attractive now. Also, when I've been bullish on precious metals for a while, so that's nothing new. I'm a broken record there, but I do have to say that gold trades like a champ in light of higher interest rates and sort of a trading range dollar situation. But gold's never traded this many days in a row above 2,000. So I think that that's a good setup for an eventual breakout to the upside. And I think maybe it'll take silver with it. And the gold mining stocks have just been death. It's been torturous to own them. But I do think that it's hard to see how they can get beaten up even more, even though I probably have said that in the past before as well.
Mm-hmm. Interesting. And your thoughts are, I think you've mentioned also you're surprised on the gold performance.
Yeah, the gold, I think all three of us, if we took out our whatever measuring stick we use, especially in regards to real yields, and I'm not talking about on the 10-year because that's not what I'm looking at, the real yields. I'm looking at it. If you're fighting inflation, you jack up rates on the overnight money and short-term yields, high real yields on the short term will usually destroy gold. And I've learned through the Volcker years, I know what my inner Volcker feels like. It's emptied my pockets at times, but I learned a lot of lessons, very valuable lessons. Yeah, gold has been an amazing performer because again, where I was looking for 1580 to 1630 as a very correctable area after all this, once the Fed started raising rates. Doesn't mean I was short. I haven't been short. I respect what I see, and I've owned gold against a lot of the currencies, which has still been a good play. I was long a little bit this morning. I'm trading it. I'm not getting married to it. But as Peter talked about, and I talked about, I think that when Peter and I were on, we talked about it because one of the great global macro traders, Druckenmiller, had come out that he was rolling out of the so-called some of his Mag 7s and buying Newmont and Barrick. And from the day that we talked about it, Newmont dropped $4 because on a bad earnings report that's up nicely today. And I've actually started buying some, but the gold stocks are miserable. I mean, it invokes Mark Twain's view that a gold mine is a hole in the ground with a layer at the top. But we know that bad management is bad management. And no matter how precious the asset you control is, bad management can run high quality assets into the ground, so you have to be careful with them. But they can't stay this divorced for a long time, especially with the yield. Between they're both paying. Newmont cut their dividend, so they're both probably paying about 2.8, 2.9 in dividend, which is not bond-like anymore, but it's not nothing. And so I want to see if they can get a little momentum into the gold stocks. I have been buying some. I'm still very bullish on the Japanese banking sector. I think that is still massively underperformed relative to the rest of the Japanese market. And as some people will criticize me going, well, Japanese banks are this and that. My favorite one is Tokyo Mitsubishi. And it's not just for what goes on in Japan, but Tokyo Mitsubishi and the fact that, again, it's ad nauseum, but they own 23% of Morgan Stanley. And if the boards would talk to each other and get their crap together, Tokyo Mitsubishi become a major footprint in wealth management in Asia. And as we've all agreed, that's where the wealth creation is really taking place. So the wealth management business throughout Asia can be very, very lucrative. And that's been UBS has done so well because they realized what was in Asia, and their wealth management business has gotten, first of all, a lot better, but it has a huge footprint in Asia, which is what started really buying that. So I mean, these are all things that I like. I still like the commodities. Peter talked about it. The ag sector, China can slow down all they want, but they're not going. The ag sector isn't going away. I love Bunge because Bunge has a big presence in Brazil. Therefore, and Brazil has become a major, the largest producer of grains, the largest producer of soybeans in the world. So all these are out there. They pay nice dividends. Yes, they're going to correct. And if you want to see how the stock market is at times just so ridiculous, when Bunge was put into the S&P 500, it had an $18 rally that day, only to take the whole rally away and more over the next preceding week. So, some things are just preposterous in the way the market treats it and the way the passive investing forces certain participants to do what I would consider to be, I'm not going to say stupid things, but ill-advised. It's a much softer word. So I'm still looking at these things. I don't own an American bank. That's to my detriment because JP Morgan has certainly done well. Bank of America, Wells Fargo, I do own some preferreds in them, but I don't own any of the equity. I like other global banks, and it's still, the European financials are interesting to me, especially Commerzbank, which has been a dog for, I can go back to 07, 08 when it was just like Deutsche Bank was a very beloved, but I love Commerzbank, and I like it even more because when I see that Ken Griffin from Citadel is looking to get into the European financials, and especially, again, and I stress this, that if Europe, which does not have a bond broker situation like the United States, we don't have that. They don't have that type of system. But if they go to that, where they go to a primary bond broking system, they will demand that you be domiciled, because that's what the ECB paper of like 2017 said, that if they go to a bond situation like that, you will have to be domiciled in Europe. That to me makes Commerce that much more advisable. I can't believe that somebody like Ken Griffin isn't going to start moving that way because it's such a cheap way to get into that. So it's just one of those things that I like, and they started paying a dividend again, which is always important to me. But those are the types of things I'm looking at. I'm not touting them. I always advise, go do your own work. If you think the idea is good, and find your own risk levels, because I'm not setting them for you because you're not paying me enough.
Okay, great. And just where can our listeners learn more about your work? David, do you have any special offers on like a trial of your research?
Everybody on this call will receive a 30-day free trial of everything that I do. So if you provide the link, that'd be great. Or come to information@rosenbergresearch.com, and we'll get you signed up. Fits in with my deflation view. Think about that. A whole 30 days with my favorite 4-letter word that starts with F, free.
Awesome. Okay, great. And Peter?
Can't beat that price. Wealth management services, they can, if you're interested, you can check us out at bleakley.com. And if you care what I have to say every day, you can check me out on Substack and trial it there as well.
Yep. And Ira?
Basically, all I'm doing right now is the podcast with the Financial Repression Authority, and the fact that, I get to sit with David Rosenberg and Peter Boockvar, amongst others. To me, these have such great value when you go out there. The fact that, we can interchange these ideas and really get through them. I love this. So, I think I love to go back and listen to old ones I did with David and I and Peter. So there's so much great when you can discuss like this, you can ferret out real ideas, and as David said, the people aren't opening up because they don't want to read that. That is so anathema to the way that I think all of us, because we have high standards. The first thing I read every day is people who I know I'm going to disagree with, because maybe they're going to enlighten me as to, well, I didn't realize that, and there's an opportunity there. I don't understand. So when David said that they don't open it because, that's exactly who I was. Well, let me read that. What is he seeing that maybe I'm not seeing? What is she seeing that I'm not seeing? That's where I want to start my day. Because I
will never not read David's piece every day, whether I agree with him or not. I will never not read that every day. I can be on vacation. I can be anywhere. It has to be read.
Well,
absolutely.
I need more people in the fold like you guys.
Well, that's easy. People say, well, Rosenberg hasn't been right. I said, it doesn't matter. You want to take away his 40 years of doing this and you want to look back, if you would have, he may be early. And you know what? Any technician that I know, any chartist that I know, early is wrong. Yeah, I get it. But that doesn't mean that you're not prepared for what's coming down. And that's what I want to be. A lot of people, I was early in 05, 06, and people kind of laughed at it. But by 08, and I was just having this discussion with somebody when the market was down 45%, and my kids had been yelling at me because I managed their accounts that we had put together in 07. They're going, Dad, you're not in. And then when they saw the returns after 08, they go, how did we make 5%? And everybody's down all this money. I said, yeah, I know. Now you're going to come back to my brokerage services. I'm going to raise the fees I charge you. You go, yeah, sure, Dad. Whatever. but that's the case, and you want to be prepared because, again, they're hurting. Was that your piece today, David, on hurting? Yeah, I think it was. You mentioned it. It's very no. I want to read people who I respect, who I disagree with, because what am I missing here? That's the most important thing. So when David said that, I was really kind of laughing because, but I've learned this over time. I've been lucky and I've had great mentors. Listen, I've been very close with Bernard Connolly, who was the head economist at AIG London. And I said to him in 08, I said, Bernard, you put out such great work. It's too bad nobody at AIG ever read it. So, David, that's the greatest compliment I can give you.
Well, thank you, sir.
Great words of wisdom. And it's been a fascinating discussion, whirlwind tour around the world, global perspective. Thank you so much, David, Peter, and Ira.
Thank you.
It's great being on again.
The FRA Roundtable Insight Show is for informational and educational purposes only and should not be considered as a solicitation or offer to purchase or sell any securities. The investments, investment strategies, and investment philosophies discussed or presented on the show each involve their own unique risk factors which are not discussed on the show. Any discussions among the panel participants or responses to listener inquiries are based on the personal opinions of the panel participants and do not take into consideration the listener's suitability, objectives, or risk tolerance. Please be advised that you invest or speculate at your own risk.